I think something important came out today. The FOMC meeting minutes came out today, and they described their plan for how they're going to decrease the balance sheet. The Fed balance sheet was upwards of like $9 trillion, 2 times larger than it was back in 2017, the last time we did quantitative tightening.
We think about buying more of the underlying token and like having like bigger gains when it goes up and bigger losses when it goes down. That's not exactly what we're talking about when we're talking about leveraging ETH. What we're talking about is generally using Lido Eth as collateral, borrowing ETH against it, which is a very safe play because those two tokens should basically trade effectively identically.
And there's a reason why those exist. So if we go back to how ETH and ETH Maxi works, there is kind of this inherent impermanent loss that happens.
Oh yeah, you'll get a permanent loss as the two tokens separate. For sure.
Right. You're going to have ETH Maxi is going to increase in price as ETH stays the same. Welcome to Alfalfa. Thank you for joining us. Thank you for being with us today. A little housekeeping. Crypto Kebab, aka Arman Asadi, is out today. He's at the Bitcoin conference right now with some collective shift crew. He mentioned that Bitcoin conference is definitely the opposite and very different from ETH Denver. So I'm sure we'll get the download from him on the good and bad of the differences between ETH Denver next podcast. And like I mentioned, he's with the Collective Shift crew. So friends of the pod, good to give me a shout out. They give us a little discount codes. If you're interested in checking them out, use discount code Alfalfa to check it out. And then last thing, we're going to answer some Discord questions today that came up in the last week. So hop in the Discord, go to alfalfapod.com. There's a bunch of short links there. You can click it, hop in the server. All levels welcome, including you no-coiners. I don't know if we have any of those, but you're welcome too. All right, let's go into the Alfalfa round. Just talk about last trades we made in the last week. I'll kick it off. I bought a little. I'm looking at my transactions now. Let's see. I bought a little ETH Maxi. It's a new token that allows you to basically go 3x leverage on your staked ETH. And we're going to talk a lot about ETH staking, stablecoin staking. We're going to make this a DeFi extended episode since Arman is missing, and we want his input on some of the policy and life alfalfa that we normally go into. But anyway, I bought some of that, so we'll talk about that. And then I bought the token of the DAO that manages that token, which is called Doubloon, I believe. Ticker symbol DBL, available on the Arbitrum network. So you can check that out. Very, very small cap. So careful out there. That's mine. Who wants to go next?
Yeah, I can take it. I sold more tokens this week. Well, I did two things that seemed like kind of contradictory. I sold a lot of kind of like some remaining shit coins that I had. I had like some Matic that I'd been sitting on that I wanted to de-risk just because I don't really like the current environment. So I sold that, got more cash. But then I also simultaneously put in like a leverage long on Bitcoin at around like 45K with like a super tight stop, just in case I was wrong on the altcoins and went into cash right as everything ran up. That got stopped out yesterday, obviously, for a very tiny loss. I don't feel too bad about it. Before that happened, though, I did buy one more. I don't want to call it a shitcoin because I think it's like a great project. It's one that's treated me very badly though over the years, and that was Synthetics token. Synthetics, yes, going back to the old abusive girlfriend, but.
I'm still hodling. I'm in it for the tech. I've been in it for the tech for a while.
That's amazing. I mean, I think it was down like 95% in ETH terms, which is wild. But you know that it came across some chatter on it on Twitter. Looked into the project again. I know they ported it over to Optimism, and there's been like way more activity now that it's on layer 2. I mean, it was just like abusively expensive on layer 1. It was one of the most expensive things I've ever interacted with on ETH. It was just sort of never made for ETH 1 for the average user. So there's a lot of activity there now, I think, via way of some new perp exchanges that are running through Synthetics. So the platform started generating tons of fees. Staking rewards were like 70% single-sided staking last week when I looked into it, which is pretty amazing. And the token looks like I hate to say this, but it looks like it's bottomed versus ETH, and it's even started trending up a little bit. $1 billion market cap, but this is like one of those tokens where, like, if you were to ask me, like, what has like a small percentage of becoming like an Apple, right? Like $1 trillion project in the, probably not the near future, but the very distant future, maybe 5 years out, 10 years out, whatever it may be. I put synthetics as one of those kind of YOLO plays. The derivatives market outside of crypto is just absolutely enormous. So if we can bring a fraction of that on chain through a protocol like synthetics, I think it could be great. So bought a little bit, love the risk reward, ready to take a beating again, and that was my week.
And what you're staking that on the Optimism chain, or where?
Yeah, I'm staking it on Optimism.
Okay, yeah. So the token price is at $5.40. I'm in during DeFi summer at like $20.
Cool. I didn't realize the price. I'm already down 20%. So that's
but you do need it. Like I was playing around with options protocols on Optimism, and you need synthetics, like the platform to operate in there. Pretty interesting. All right, I'll go with mine, and the theme of my Alfalfa has been like sort of just de-risking still. I think on the last episode I was talking about closing my shorts, and I re-entered those. I'm shorting shit stonks again. I think something important came out today. The FOMC meeting minutes came out today, and they described their plan for how they're going to decrease the balance sheet. The Fed balance sheet was upwards of like $9 trillion, 2 times larger than it was back in 2017, the last time we did quantitative tightening. And their plan is to sell or let roll off like $95 billion worth of treasuries and mortgage-backed securities every month. So what that means for us, the investors, is like money is coming out of the system. And how that affects individual securities, I'm not sure. But from my history is that like the highest risk curve assets are probably going to fall the hardest. So that's where I'm looking to decrease my exposure.
When you're shorting these shit stonks, are you using derivatives or using options, or are you just going short?
Both. So I'm buying puts on these shit stonks, and I'm just selling outright. And then I'm also selling puts on stuff that I really like. I think that's like a good strategy, even in a down market like this. If you want to own something on a dip, ETH's down 7% today, probably has further to run. But like if you want to start to acquire more ETH, I think one way of doing that is selling out of the money puts. That way, if you lose, you buy a dip. Right. So that's what I've been doing.
Okay, cool. So let's kick off our little DeFi special by going into a little bit of what you touched on, Eric, which was the FOMC meeting minutes, and just kind of get a picture of the broader market. It seems like crypto has this kind of like two faces to it. Sometimes it follows these inherent like crypto native narratives, stories about Bitcoin and about ETH, and things kind of go up. But when the overall macro market gets upset and goes risk off, it falls right in line with any other risk asset. So I haven't had a chance to read the meeting minutes. I usually do, but today I haven't had a chance. So you gave a little brief overview, in that essentially the conclusion is that money's coming out. So yeah, any more details or what that means broadly, specifically for the crypto market?
Okay, so let's just compare it to the last tightening cycle, which was in 2017. And we saw that lead to a mini recession in 2018. So in 2017, the Fed balance sheet was $4.5 trillion. Okay, that was the size of the balance sheet. Now it's $9 trillion. And that's like on the heels of printing money, et cetera, after COVID. So the balance sheet's much larger, and they're going to tighten much harder because of that. And we're also like seeing massive inflation. So they have to combat that. and they have to decrease their balance sheet. So they're going basically like 2 times the size magnitude of what they're selling from 2017. What's also important is that the Fed is going to raise rates at the same time. And what we thought was going to be slow and gradual is probably looking to be a lot quicker than what we had estimated. So I think they're looking at 50 basis point moves every quarter for as long as we need it, until inflation comes back down. And I think the market was not ready to hear this. Go ahead.
Follow-up question on that, and this is for both of you. Feel free to answer. But you mentioned that the Fed is decreasing the amount of quantitative easing. They're reducing the balance sheet, and the Fed is increasing rates at the same time. So is this a double whammy? And if, let's say, the Fed wasn't increasing rates right now, would the decreasing of the Fed balance sheet start to naturally increase interest rates? Like we'd see the 10-year go up just because the Fed is decreasing their balance sheet, meaning they're not buying as much bonds and treasuries as they normally do. So without as much, demand, interest rates start to go up naturally. So is that true? And then are you saying it's a double whammy because both are potentially happening at the same time, or will be happening at the same time?
That is true. But like the long-term ramifications is harder to decipher, because I think the long end of the yield curve is probably going to flatten on its own. So I think in the short term, we'll see a spike. And then naturally, just because demand is not really there, because I think we're going into a recession, I think it's just going to flatten and invert anyways. So it depends if you're asking about the long term or the short term. But definitely in the near term, I think we're going to see a huge spike.
Right. So today's April 6th, we're recording in the evening. Right now, Bitcoin is down 5%, ETH down 6%, and the whole kind of crypto market in general along with it. So let's talk about what we should do here. Like, we obviously hold these coins. We hold Bitcoin, we hold ETH. We're long ETH in general. So let's talk a little bit about what we should do with them, and maybe talk a little bit about ETH staking, given that we have this kind of macro environment. Steven, should we go through the basics of, staked ETH to start, or do you want to start with some more advanced strategies possibly? You're also on mute, Steven. And we're back.
Excuse me. Yeah. So what do you want to do? Do you want to sort of jump into staking strategies? Do you want to talk about more like kind of macro, long, short type stuff? Or?
I think the directionality is good to start with, and then we can sort of drill down.
Cool.
Yeah. That's always, I've got a million people texting me constantly, like, should I buy here? Should I buy here? Should I buy here? The answer, by the way, is always, I don't know.
Give me the alfalfa.
If I knew the answer to that question, I would be on a yacht somewhere.
But doing this podcast, you'd still be doing the podcast just from.
You're right. I would still do the podcast, but
we've talked about this.
Be doing it on a yacht in the Caribbean somewhere. It's mostly about managing risk and outcomes for me, right? Not predicting exactly the direction. I think generally speaking, holding like altcoins, right? Anything that's basically non-BTC, maybe non-ETH is still very dangerous right now. There's a lot of stuff where if you pull up like the chart of Solana, right, as wrecked as it's been this year, like you go back barely like a year and a half, and this thing is still up 100x, right? So if bad things happen in macro, like some of these things have a long way to go down still, even though they're already down 50%, like you can easily lose another 75, like if we go totally nuclear. So not sure about the risk reward in some of these things. I've been, looking to get back into Bitcoin ETH. I haven't really bought a lot of spot yet. Obviously I wish I bought some spot ETH in the low 2000s, but I did think there was, pretty large risk of us going super nuclear on ETH. The 200 week, which is kind of a nice like marker for where we often capitulate to on ETH, is still really, really low. I think it's around 1,000 still, right? And I can use that as a mental framework for how bad could it get.
Max pain.
Yeah, that's way below here, and it's It's tough. Like I'm balancing these two things in my head. One is that macro looks like terrible, but the other is that ETH2 is hopefully right around the corner, and I do think that is going to be like a really bullish event for ETH, if not like immediately, at least over the near time. So I think I'm probably gonna buy more if we get another run. I think it's pretty likely we kind of dip back into this kind of like 2,500 mid 2000s range. Seems like everything is really setting up for this scenario where the Fed sort of nukes us going into the summer and everybody just completely loses their mind. That's definitely a scenario I have on the brain. But if that does happen, I would be looking to buy the panic there in that instance. I didn't really buy the panic earlier this year. I took some off the table, kind of wrote it out, didn't really make any big swing trades or spot buys because I kind of felt like that was probably not the last of the nukes. But if I was wrong, I was happy to be wrong. I still have a lot of ETH and I'm still making gains. I'm just really focused on protecting, the cash I have, protecting the assets I have right now because it's a crazy environment. It just does look like it's going to be like a year of like chop. If that's like kind of like my baseline scenario is that we don't really go anywhere for a while. But in the event that we do, like I would be looking to buy in the low twos and just kind of stake and chill, as we say. I do think staking is going to, we can talk about this in a little bit later, but I think there's going to be some crazy APRs on the staking. And when you factor that in with the long run potential that, some of the short term downside doesn't quite seem so bad.
So before we get into the staking, I have a question since we're talking about directionality. The merge, you mentioned the merge as this potential, event that could move the market up or down. My question I've been asking myself is this one of those buy the rumor, sell the news events? Like buy leading up to the narrative potentially coming, and then once the event happens, not that we would potentially sell our long-term bags of ETH, but just understand that things could dip down, especially since you may have a lot of ETH that's been locked up for quite a while now become available to will become liquid and available to sell. So what are you guys' thoughts on just the event and how to trade around it if you are trading?
Yeah, I mean, I definitely have some thoughts on it. My thought is it's a little more complicated than people make it out to be as a buy the rumor, sell the news thing. I think it depends on a multitude of factors, right? It depends. Like obviously, people have been kind of front running this a little bit lately, but it depends on who is buying, right? Like if you're going to get a different reaction if the run up is a bunch of perp traders, people who aren't buying spot, they're buying like leverage derivatives, as like a short term trade in the run up, versus people if it's like a spot driven rally, right? And then it also depends on whether the merge is like on time or early or late, right? So those two factors and the combinations between all of them could definitely result in like 6-7 different exact scenarios that could happen. I'm definitely not looking as a default to do any selling at this point. Like I'm viewing this as sort of like the final hodl, if you will. I think we've got maybe one more kind of really bad dip ahead of us, and then from there, this is it for me. Like I'm accumulating all my ETH, and I'm just like never gonna let it go. I'm just gonna stake it, and I'm gonna move on with my life and enjoy my future riches. Right? Not super interested in doing any more trading after this event, unless there's some insane thing where it runs up to like 200K, and I'm like maybe I should take a little off the table, but it's just probably not going to happen.
Well, yeah, I think like I'm of two minds. Like you have the long-term view of ETH, which like we're all pretty certain that this is going to go over 10K, in some time horizon that's intermediate. I do think that like the near term looks pretty bleak, and we're all sort of like optimizing for more ETH. So if I can like sell 3,400 ETH and buy 2,500 ETH, that gives me more ETH. Man, I do think that like Steven points out like something interesting. Like if there is enough demand for spot ETH because of the yield, then we get into like squish chaos territory. Like there's more demand than there is liquid supply, and we could see something weird squeezy. But the thing I keep reminding myself is that like crypto moves at the speed of light. Like 1 week seems like ages, and there's a lot of time until July, and that's like our estimate of when the merge is set to happen. So that's how I'm playing it and looking at it.
Yeah, so it seems like in general we're short-term cautious, potentially bearish, but long-term bullish. So we got the stage set for direction in the short term and long term. Let's talk about staking, because I'm not necessarily trading ETH. I'm just, like Eric said, just trying to get more tokens over time. I'm more of a Ronco set it and forget it guy. If you're in the US and you watch these old school like infomercials, there's this guy Ronco had
the rotisserie chicken.
Yeah, the rotisserie chicken oven, and his whole shtick was you set it and forget it. And so when I think about staking, I've been staking in Lido, and I'm going to set up a validator here before the merge to play around and just kind of increase knowledge on what it takes to get it set up.
Okay, big dog. Okay,
yeah,
big boy.
Need to, because with Lido you can stake and you get some a liquid token ST ETH in return, and you get your 4% yields, and they take a 10% rip off the top, which is fine. I'm happy to trade that in terms of like some liquidity and some ability to juice those yields in DeFi. But as we talked about, when the merge happens, there will be an increase in return. And I realized the way that Lido's set up, as a ST ETH holder, you're not necessarily set up to capture that immediately increased yield for however many months that thing lasts for. So I do want to capture that, and the only way to do that is set up your own validator. And the current wait time is like 14 days, and I expect that to get to months before your validator becomes active.
Brilliant. I wasn't thinking about that. That's brilliant, because there's going to be so many retailers coming on board for the yield, and like that's going to dilute the Lido yield for like a 2-week period until they can set up new nodes for all these new stakers, right?
Right. So we have about 14,000 pending validators. So these are new validators set up, waiting to become activated. And that first, if you set one up today, your estimated activation would be April 22nd. So you're looking at 16 day activation date. And I think that's going to go up drastically. And so, yeah, the only way to make sure you capture that is to have your own node. And
you can get slashed. Couldn't you get, like, there's risk there. You can get slashed.
Man, hopefully I know what I'm doing. I'm gonna set up this virtual private server, and I'll definitely share the notes once I get it set up. Gonna make sure you have full uptime, full internet connectivity, no power outages, that kind of situation.
Okay, so just so I'm clear, when you do your own node and you stake ETH that way, you don't get sort of that DeFi token alongside it. You don't get the staked ETH that Lido provides.
Right. So here's my basic back of the napkin. Right now we're getting 4%. I think the validator returns will get up to 10%. And I want to capture that. And certainly you can do some of the things we're about to talk about to juice your yields from 4% to 10%. But I also just want to learn and kind of also participate in the network and, help validate some transactions, and maybe I learn some things along the way. But yeah, so definitely won't have those additional DeFi capabilities, and my ETH is going to be locked up until the merge actually happens. But I do believe the rewards are liquid, so I can kind of pull those off.
Okay, so Steven, how high can you juice like a ST ETH yield without going too degenerate? Like,
yeah, I mean, look, I'd like to back up for 1 second and talk about something, because we're talking about yield, right? And I think we always talk about the yield from like staking rewards. What I think people are really overlooking is that there's going to be a lot of yield available in the form of MEV, right? So if you're setting up your own validator, Nick, like my question to you would be like, do you have a plan to figure out how to capture that? Because if you don't, like, I think you're going to be potentially missing out on like a gigantic swath of so-called yield, right?
So,
and this is one of the reasons why we talk about Lido a lot, and a lot of people may ask. I also ask, I think, like, why should I do Lido? Why shouldn't I do Coinbase? Why shouldn't I do my own node, right? And it might be interesting to talk about some of the benefits and drawbacks of that. I mean, I can hit on them really quickly, right? Like, good. Lido is really great for a few reasons. One, you get composability, right? You get this token that you can use as collateral very easily. You can swap it for other stuff. So if you're using DeFi at all, even in like a long-term sort of like mostly hands-off, semi-passive way, has amazing utility in that, right? The other, which I think is really, 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 really important, is that Lido is going to be giving MEV returns to both the token holders of Lido as well as the validators themselves, right? And I've seen estimates for these returns anywhere from like 10 to 20% in like the near term, right? So you could be talking about a scenario where like the returns from MEV are, 3 or 4 times what the actual staking rewards are. So I guess this would be a good point in time to jump back to you and say, like, do you have an MEV plan, or is this just purely like I want to do this in like a small scale as like a learning experiment? Although 32 ETH is quite the learning experiment.
Right. No, so when I was saying and learn a few things along the way was to basically set it up and then kind of start delving into some MEV arbitrage opportunities. And the only way to get started is set up your own node, and then probably we'll be teaming up with the developer to come up with some really basic kind of low risk strategies, and then maybe venture into some more complex stuff. But in addition to having the 32 ETH for the validator, you also need capital to kind of run these arbitrage plays. So that's the part I hope to learn more about and get active in.
Steven, just so I'm clear, when you were saying that Lido is going to give MEV back to the community, you mentioned that they might pay it back in the Lido token, like to Lido token holders. And you also said they might give it to validators. Are you talking about validators like sub 32 ETH, sort of like people not running their own nodes,
No, I'm talking to like there's like two people in Lido, right? There's people who own, there's Lido token holders, right? They literally own the Lido token, which is the governance token for the protocol, and I believe it accrues fees or will accrue fees, percentage of the fees from staking and MEV. And then there's the people who are using Lido by staking their ETH with Lido and getting, the ST ETH token, right? So those people are effectively like running validators, but like through Lido in like this like decentralized fashion where they don't need to
like partial validators, probably.
Yeah. So the plan is to give those stakers like a portion of those rewards. I mean, there was a like a big uproar of this like a long time ago. I mean, I remember people talking about this in very early 2021, 2020, late 2020, about how there was going to be this like massive opportunity for companies like Coinbase or Kraken or like protocols like Lido or Rocket Pool, right, to basically capture like massive amounts of like value via MEV, miner extractable value, which I think they're going to rebrand to something else since there won't be any miners, right? And just for the listeners who are like, what the hell is MEV? To uber simplify it, right? There is value in being able to decide which order transactions go in a block, right? So validators are going to be the ones kind of doing the blocks in the future, instead of the miners, the people who are staking, right? So you may have the opportunity to get bribed by particular people to put one transaction before another one, or, people can do sandwich attacks, all these things, right? There's value there to be captured. And initially people were worried that a lot of these, it's still like, I don't think Coinbase has said anything about it, right? So for all we know, Coinbase is going to be letting you stake ETH and collecting your 5% there, but then they're going to be like operating their own like MEV operation and maybe yielding an additional 10, 15, 20% off of your ETH and not giving it back to you, right? It's definitely a possibility. So this is like a pretty hot topic, and I think it's going to come to the forefront more as time goes on. I still think the market still hasn't fully grasped just the implications of ETH 2.0 at all yet. Never mind these kind of other details. So it'll be interesting to see how that plays out.
It's such a good point, man. I think the fact that you can basically be running an MEV bot by staking, not doing anything. Like Lido is going to be doing it for you. Of course, they'll take their cut, but like the fact that you can get that alpha just by staking is so huge.
Yeah. So if someone wants to look up an example, because we're going to move on here in a second, but like if you want to look up an example of MEV, Steven mentioned the sandwich attack. So Google, sandwich attack, ETH, and you'll see some examples of like how MEV actually plays out and why there's value to accrue there for the validators, and you want to make sure you're part of that and it's included in your returns. So let's get to the next step and talk a little more about what to do with your ETH.
You want to talk staking strategies?
I do.
All right, let's start off with the basic one, right? There's probably a lot of people listening who don't even use the Ethereum blockchain, right? And they're like, how do I take advantage of this? Like, simplest way is probably just use Coinbase or any other exchange that offers staking. Buy your ETH on Coinbase, stake it there, collect your 5%, pay them their fee, whatever it may be. But you're still going to take part in it. You're still going to get that yield, right? It'd be a real shame to leave like, 10, 20, 30 ETH on Coinbase for like 20 years in your retirement account and just not stake it when you could have collected 5% a year for 20 years. I mean, you'd have probably like 150%, maybe 200% more ETH when you retired, which could be like a very costly mistake if you don't do that little thing. So that's kind of the basic thing, right? I think then beyond that, we're getting into the a little more advanced stuff, and it depends on how crazy you want to get, like how complex you want to get with the setup, also like how much maintenance that you want to do. I think a great intermediate strategy for people who are, I want to do a little more than Coinbase. Maybe I want to self-custody a little bit, but I don't know about all this Lido stuff. I don't know about all this like leveraged yield stuff, whatever. Really great one is the Argent wallet, which is just an app. We talk about Argent a lot. It's an app you can just download in the App Store. And they basically have like a one-click button where you just well, first you got to buy some ETH within the app if you don't already have it, which is also very easy to do within the app. But then you just one click, and they have like an app within their app that basically uses the ST ETH pool on Curve through Convex and Yearn. And last I checked, I think it was 7.5% on your ETH using that, which is going to be substantially more than what you'll get on Coinbase, and more than what you'll even get just staking it directly in Lido. So I think that's a great option for sort of the intermediate people, right? But then when we talk about like doing more advanced stuff, right? I think step one is like learning how to use Lido, staking your ETH through Lido. We talk about Lido a lot. Lido is, in my opinion, the best because it has the largest network effects. It has like the most use and utility throughout DeFi, right? Like the fact that Lido ETH is available as collateral on Aave is enormous, and that's of enormous value to be able to do stuff with your ETH. So step one is sort of stake in Lido, and then I think from there things get a little bit interesting. I think maybe we're gonna we probably have some of the same strategies between us, so maybe we'll share one and just kind of rotate. I'm gonna try to go in like sort of the order of like complexity, I guess, right? So step one, Lido ETH, collect 4 or 5%, and then maybe when this rolls out, those yields get juiced to 10, 15, 20%, and then maybe even we get an extra 10, 20% of MEV on top of that. Those will all compress over time, I'm sure, but like definitely,
don't tease us.
Definitely do that.
That's gonna be so
Getting
good.
Everybody's hope up.
All paid in ETH, right? Like, or you get Lido token for that, or is it all paid in ETH?
I think it's all paid in ETH.
Oh, yeah, you're so glorious.
Every day I like looking at my ST position, and it rebases once every day, and that number just ticks up, including the amount that I have held in Aave as collateral.
Yeah. So,
sorry,
you muted yourself there.
Oh, sorry. I'm like talking about getting more ETH by like guessing direction of ETH and selling it and buying it when it's lower. It's like, this is so much easier. Just freaking stake and accrue. It's so much better. Stake and chill.
Ronco.
And I think the easiest to kind of like more advanced staking strategy, and you touched on this, Nick, this is the leverage staking strategy. And even this strategy alone, there's like multiple ways to accomplish this. And I think a lot of times when we talk about leverage, we think about buying more of the underlying token and like having like bigger gains when it goes up and bigger losses when it goes down. That's not exactly what we're talking about when we're talking about leveraging ETH. What we're talking about is generally using Lido ETH as collateral, borrowing ETH against it, which is a very safe play because those two tokens should basically trade effectively identically, right? You're not going to get liquidated unless something really, really goes wrong, like really nuclear, right? But once you borrow ETH against your Lido ETH, which is typically a very cheap thing to do. Like the rate on ETH is creeping up now, but for a long time it was like sub 1% to borrow ETH. So it's sort of like an arbitrage trade. You borrow ETH at 1%, you stake it at 4%, and then you take that new ETH, that new ST ETH that you got, put it back, borrow it again, and you just keep repeating that process. And every time you do that process, you tack on like 2.5% or so to your yield. Doing this manually is not something I would recommend. It's going to cost you a lot of time, a lot of gas. There are a couple ways to do this. I think the simplest way, the simplest way without taking on any additional protocol risk, I should say, is to use, I like InstaDApp. So InstaDApp has a new little side app they launched, InstaDApp Lite. So basically you can just use InstaDApp and it'll in one transaction basically sort of cycle your ETH and Aave. And last I checked a couple hours ago, it looked like you could basically just take ETH, put it into InstaDApp, and you get ETH that basically yields 10.5%. Done. And then you can kind of just do that and walk away. Downside of this strategy, you don't have anything to use as collateral, right? Like if you use ST-ETH as collateral to borrow more ETH and leverage up, when you're done, you have a high yield, but you can't really borrow any more money against it if you've like kind of maxed out your leverage. So that's like the main downside of that strategy. I feel like I've been yapping for a while now, so I think Eric and Nick, if you guys want to jump in.
I can just touch on, there's another way of going about this. So there's a new token that launched, I believe, earlier this year called ETH Maxi. And essentially it does exactly what Steven's describing, and rolls and accrues all the value inside the token. So for every 1 ETH you trade and purchase in the token, it essentially goes 3x leverage. So it does the process that Steven mentioned. It stakes in Lido, takes the ST-ETH, it deposits the collateral in Aave, and then borrows ETH against that collateral, and then does this over and over recursively until you're 3x leverage. And they estimate that the yields get up to like 9 or 10%. And again, it depends on the borrow rate of how much it costs to borrow ETH against your staked ETH. I'm looking at it right now, and Steven, I think you're right. It's just under 1% is the current borrow rate. That's variable. It could certainly change. And so risks with this strategy. One, there is a DAO that manages a smart contract that does this kind of recursive depositing collateral and pulling and borrowing. So there is a little smart contract risk with that. The other risks, which are also kind of inherent in doing this manually, is that the depegging of ETH to staked ETH, which again, I think we feel pretty comfortable with. It's certainly if Lido has any like cataclysmic issues that could depeg. If anything, I think it'll depeg in the sense that staked ETH will have a slight premium to ETH at some point. But anyway, with this ETH Maxi strategy, you purchase the token, and the way it accrues is that the token value goes up. So right now, I think ETH Maxi trades at about a 2% premium to ETH. And over time, it should go up about 9% a year, because that's the yield it gets on using this strategy. So
it's not a rebase token, is that correct?
Correct.
Just the price goes up instead of you getting more of the token? Because that's structurally different from Lido, right? Lido ETH, I think you get literally more of that token sort of accumulated in your wallet, right?
Right. So if you're just using Lido and staking ETH, you would literally open your MetaMask wallet, and every day you'd see a little more staked ETH, ST ETH in your wallet. With the ETH Maxi strategy, it is using staked ETH in the strategy, but it doesn't rebase. So the amount of ETH Maxi you have stays exactly the same, but the idea is that the price of that eMaxi token increases over time, and it should increase according to the yield it gets every year. So if it's 9%, that will it will always increase against ETH about 9% a year. So in 2 years' time, we should see ETH Maxi at about call it a 20% premium to ETH, whether it goes up or down. So if ETH crashes, to 1,000, we should see ETH Maxi at like 1,200, for example. So that's how that plays out.
Okay, so ETH Maxi is for sure Ronco type strategy, set and forget, and like watch the number go up over time. Right. Do we have any idea of how like MEV is treated? I guess would they be capturing? Would ETH Maxi be capturing?
I would assume it would all accrue to the ST ETH, which is sort of wrapped into that token. I would assume, but I haven't looked that deeply into it.
To the extent that ST ETH, staked ETH, captures MEV, that's the extent to which ETH Maxi, benefits from MEV. And yeah, there's a little additional like smart contract risk, but I think if you're looking for something easy, the market cap is still really small, so it's not a lot of money. I think it's like a $3.5-4 million market cap. So you might want to like keep an eye on it. That's how much. Yeah,
it's so small.
It's tiny. So you might want to keep an eye on it, watch it grow, wait till there's at least $100 million in this thing. But I certainly think smart money will eventually use it, and I'm hoping that it'll be, you'll get this composability effect where it'll be used elsewhere in DeFi. Potentially, if you want to go super degen as collateral in, say, Alchemix, and have like a self-repaying loan where you can borrow stables against your ETH Maxi position, and they'll use the yield to pay off your loan over a very long period of time.
That would be next level. I mean, it's not even next level. That just feels inevitable, right? We're gonna get a leveraged yield token that we can use as collateral to do more stuff with. It's a beautiful thing. I feel like we should also mention too, by the way, since we're talking about these leveraged tokens, are you aware that Index Co-op has their own version of this token as well?
Is this the 3x like FLI one, or is this something different?
It's I think it's called IC ETH, so it's leveraged, but only the yield is leveraged. I think it's like ETH Maxi. Okay. Index Co-op is like a very big, like kind of long-standing. They do the DeFi Pulse Index, right? So they're pretty. We talk about like ETH Maxi having a small market cap. This is like a big, been a fixture of DeFi for a while. I would be curious to see the fees in ETH Maxi. Have you looked into that? Because I think that there's like I think it's in aggregate. I think there's like a 0.25% fee and like a 0.75% redemption fee or something. So and I have to look at that Index Co-op.
It's a 1.95% streaming fee. And the way it's calculated, I was asking the kind of project founders in the Discord, how do I go about forecasting this fee? And it's 1.95% times the market cap of the token. So the current market cap is $3 million. You multiply that times 1.95%, and they take that out every block. So every block that's mined, they pull that out, and that is the income to the DAO. So that's how much the DAO makes money and how the DAO makes money for managing it, which is why I also like going.
Doubloon's gonna fucking run. I love
I'm gonna go. That's why I'm going full degen on the DAO token, because I'm like, okay, if this narrative really plays out, this is like a really high beta way to play the ETH staking narrative. People are gonna learn about validators and they're gonna learn about Lido, and then all of a sudden someone's gonna be like, well, did you know you can go 3x leverage on staked ETH using this token? And I think the amount of money that will go into it will grow. And then the DAO should benefit, and maybe one day, the meme coiners will ape into the DAO token at some point. You kind of see this with certain DAOs like Treasure DAO and other cases like that. The market cap tends to increase as people utilize the ecosystem that they're kind of building, and they have other tokens. But in any case, that's how the fees work.
I don't want to get too far astray, but we're talking about fees. What's Lido's fee? Lido takes a fee for
10%.
10% of your yield. So like there's no loss to you. It's just like you get 90% of what your gain would be. Okay.
Right.
That makes
Yeah, and the
sense.
streaming fee on IC ETH, by the way, is 0.75%. I just looked it up.
So ETH Maxi is kind of expensive in terms of a management fee.
Yeah, it
But
seems
but
that
it's
way.
expensive to run that 3 times recursive on your own with gas and everything. That's like probably more expensive actually.
It depends on how
Depends on how big you are.
big your thing is and how often you maintain the position. You
Right.
know, like if you're just going to set it and leave it there for 2 decades, it's probably a rounding error.
Can I
Plus,
ask you
you're
guys?
gonna
Can
go
I
in and
ask you
out,
guys
you're
about
gonna get
a
wrecked.
different strategy? So like the one that I was familiar with was like you take your staked ETH, you convert it to bonded ETH, right? Steven, you're familiar with this bonded
Yes.
ETH on like the Anchor protocol. That's like the Terra network. So you convert it to bonded ETH, and then you move it over to Anchor protocol on Terra, and then you borrow against your ETH to get UST, and then stake UST for 19.5% yield on Terra. You guys are familiar with this, right?
Yep.
And
Tried
we
it.
yeah. So can we talk about sort of the pros and cons of doing it that way versus just going pure staked?
I
So
would love to.
Yeah, yeah.
this is interesting because you do get so you're basically turning into bonded ETH, right, and then moving it over, and then I think the highest leverage you can get is something like 65%. If you want to get that close to the sun, and then you get your 20% on that. So I mean, the first question I have is, does it all really back out to that much more yield? Because you're not going to really go full leverage on it. You got to create some room in case ETH goes down.
But okay, so that's my question. So like, does it matter? Okay, because you're borrowing UST, not ETH. So like in the first scenario where we're borrowing ETH against ST ETH, those things are going to be paired very close.
No
So you
liquidation risk, or very little liquidation
very little
risk.
liquidation risk. But if you borrow UST, meaning a stable coin against ETH, now you bring in liquidation risk into the play, right?
Yes, and there's a lot of nuance around this, right? I think first thing that's worth mentioning is that Anchor is on Avalanche now, so you don't necessarily have to bridge off of an EVM chain. So that's worth mentioning. I'm not 100% sure on this, so we should probably verify, but I believe when you bond ETH in Anchor, you're no longer collecting the yield. I believe that's one of the revenue sources that Anchor protocol has, is that's why they take like staked assets as collateral, because that's like a source of revenue for their obscenely high interest rate payouts. So you have to factor that in. Like right now on Avalanche, it costs 4% to borrow UST, and they're paying 19.5, right? So you're basically 15%. So if you say you go pretty aggressive and you borrow half of your value, which I wouldn't necessarily recommend, but if you did, that would basically equate to a 7.5% yield on your ETH in a position that you have to maintain, right? That's already less than these sort of like automated leverage strategies, right?
Right.
So
I was only thinking about
it's like
going
a good
using a
option.
third. I was only going like 30% TVL or LTV. Sorry,
But yeah, and then you're gonna get even less of a yield.
even
right?
less. Yeah.
Yeah. The good thing about Anchor is that if you do want to go a little down the rabbit hole, there are programs that will like automate your collateral and repayment and stuff like that, so you can actually kind of get a little bit YOLO with it and not get wrecked too hard. But even if you do that, like it only looks useful to me for somebody who wants to have like a lot of like stablecoin liquidity because they're doing advanced yield farming or trading or other stuff that like a passive user might not be doing, right? I don't really see this as being like a great strategy for like the sort of set it and forget it person, because I think you're going to get less return and then like more risk and more of a headache.
This is telling me now that the ETH Maxi token is a way better way to play this. Do we have any rewards, incentives from using ETH Maxi? Can we earn DBL, Doubloon for using this?
So there is a liquidity provider incentive. So if you provide liquidity on ETH and ETH Maxi, you get, I think it's roughly like 12% and it's split between two tokens. One is the DBL token, again, the DAO that manages ETH Maxi. And then there's this drink token, which is from Beverage Finance, which is another application, and they're kind of like helping launch this token. And so you get both of those. And there's a reason why those exist. So if we go back to how ETH and ETH Maxi works, there is kind of this inherent impermanent loss that happens.
Oh yeah, you'll get a permanent loss as the two tokens separate, for sure.
Right. So you're going to have ETH Maxi is going to increase in price as ETH stays the same. So you're going to have, how would that work? Would you have a little less?
9% per year, right?
Right.
You'll get the 9% impermanent loss.
And here's, it's not that bad because you're still long ETH, right? It's not like you're pairing ETH with a stablecoin and you end up with more stablecoin and you're less long ETH, but you could end up with less ETH Maxi when you pull it out and more ETH, which means less yield on your overall position. But you're also collecting the trading fees between the two and those two additional yields you can get. So I believe the net yield that you can get right now is 17%, all in for being a liquidity provider.
For being a liquidity provider.
And that includes that half your stack is in ETH, not ETH Maxi.
Right. So you subtract the 9% impermanent loss. You're still in the green on that. And we're pretty bullish on Doubloon just broadly.
Wait, can you go over your impermanent loss thing again? What were you saying? I don't know if I followed that.
So ETH price will stay the same ETH Maxi will increase relative to ETH. So I'd imagine there'd be some continuous impermanent loss, and I think that's the reason they're providing these liquidity incentives.
What is the incentive that they're providing? Do you know?
It's just their own DAO token plus a token for Beverage Finance, which honestly I know nothing about.
But you don't know the APR yet; it's not out yet.
No, it is. Let me get it. I believe it's like, let's call it 7% and 6%, respectively. So it amounts to something like 12, 13%. That you get from these potentially worthless tokens or potentially,
Yeah, because the impermanent loss, which is, I don't know how deep we want to get in the weeds on that, but the impermanent loss on 9% is like effectively zero. I think.
So
I think
God bless anybody who's stayed with us this long on this like DeFi only episode, but like that's the biggest alpha of all time. I think like we just discovered what's the best way to do this, and it's
it's trade-offs, right? Like I've got one that you guys probably haven't even heard of.
Right? Oh my God!
I'm about to come up on you.
Okay, so first of all,
do us one better.
So far, I think of all the things we talked about, it's very clear to me, and I think it's good to summarize it. So far, is that you go ETH Maxi, you pair that, you provide liquidity with ETH Maxi ETH. Nick, what's the protocol you would do that on, that where you provide liquidity on?
I believe it's called Set Swap Set protocol. Sorbet Finance is where the liquidity pool sits.
Okay, and that way you're getting your ETH paid in ETH, your ETH Maxi tokens going higher, ETH, etc. You're earning 13%, but with a little bit impermanent loss. I like this.
Very little. Yeah.
Very little impermanent loss. And then you can earn some doubloon and some beverage or whatever you talked about. And, you maybe dump the beverage, keep the doubloon. But Steven, I'm very intrigued to hear if you can beat that, if you can top that, because that's already very good.
Yeah. So this is definitely a do your research play, because this is a very small cap protocol. It's been around for a long time in the realm of DeFi. It's a protocol called idle.finance, and they have a tranche system, right? Which is basically like you take like two lanes of investors. One set of investors goes, I don't want to risk a lot, and I'm willing to give up a portion of my yield. And then the other lane goes like, I'm willing to take the risk. I want to take that guy's yield. And then in the event that something goes wrong, the junior tranche the high risk tranche will pay the senior tranche, right? Right. If like there's like an exploit or something, right? So IDLE actually has a leveraged ETH tranche product, right? And you can basically do the senior tranche and get 8%, which is less than what you would get doing like a DeFi Saver or InstaDApp or an ETH Maxi, right? But presumably with insurance from the junior tranche. The junior tranche right now is paying 14.5% because you're basically getting that 11 or so percent leverage yield, and the senior tranche is paying you 3% of their yield for insurance. This is actually a play I've been like meaning to do more research onto, because this is like a really small market cap. This is like a 5 million market cap token. It's really, really tiny. It's like one of these plays that was like a big hit in the DeFi boom last year, but that sort of just kind of pittered out along with everything else. But they have been building stuff still. So I think the token went from like $30 to like $1 to give you an idea of the devastation on this.
Are we talking about the IDLE finance token? Is that what we're...
Yes. So okay. I'm trying to do a little more, and again, like I can't stress this enough. This is very early stage stuff, right?
Right.
But what I would be, this is like an interesting thesis generally for investing, right? If you think that the merge is going to be this big thing, and everybody's going to get into ETH, and ETH is going to go to the moon, and people are really going to want to do the staking, and that's going to be a driver for that. Well, you could buy ETH. But a play that's going to give you like massive multiples more return might be to find like these small cap protocol gems that are going to kind of like piggyback onto that and like provide utility that will kind of feed into that generalized trend, right? So this would be an example of that. Like if people start wanting to stake ETH and then they realize that leverage staking ETH is a thing, and then they realize that this is like the highest yield on leverage staking ETH, right? It wouldn't take a lot of funds to kind of move into this protocol at a $5 million market cap to suddenly have that protocol do like orders of magnitude in valuation, right? So I'm not sticking any of my own money in this yet. I'm still looking at it, but I'm looking at it as an option for investment, and I'm also looking at the token of the protocol itself as like a potential sort of like YOLO play at my little small cap kind of section of my portfolio. So just something to keep in mind for people there.
Okay. So we've talked about if you want to like play those DAO tokens and the governance tokens, which are managing these opportunities. We talked about Doubloon and IDLE, so you can check those out if you want.
Both are very small. Let's not forget Lido as well. Like Lido is a bigger market cap, and you got to think that could be an opportunity. I mean, the token has definitely been pumping, right? It's not like nobody's realized that Lido might be pumping, but I don't think a lot of people have kind of filtered into these like small cap, like adjacently sort of related plays yet. What is Lido up to now in terms of
its market cap is 375 million.
That's a good question. What's the token price? Because I'm so allergic to fucking DeFi reward coins these days. They're designed to go down in value. So like,
well, I think that's a fine mindset to have had for the last year or two, and it's a fine thing to keep in mind. I think it's going to start becoming like a middle curve mindset pretty soon. I think the meta is going to change again, and I think that we have to be open to the idea that like actually at some point in the future, DeFi coins might not just be these things that go to zero anymore. I think more and more protocols are going to maybe start figuring out how to actually, accrue value to the token. I think the Lido token, like Nick said, they do accrue fees, right, from the staking rewards. I think that there's still a bit of inflation and emissions kind of built into that. So that's always the tricky thing when you're thinking of investing into these tokens, right? It's you typically have like they're printing money and they're diluting you as a stakeholder. So it becomes a complicated question of whether the value is going to be offset by that dilution. It's why like I never recommend to anybody like invest in DeFi coins like who's like unless we're talking about stuff that where like all the market cap's already out there, right? But then some of that stuff like Uniswap, right? It's like, okay, well, you're not going to get diluted, but is is the token ever going to do anything? Like that's like a whole different problem. Like this whole area of investing is really just a like a real experts only landscape.
Yeah, I think a true gambler's landscape too. I mean, I think you have to understand where you are in the macro market, and is there even room? Like we just talked about at the top of this podcast, that this may not be the best macro market for these altcoins, these DAO tokens to really to launch. But if Bitcoin, ETH get above the 200-day moving average, you kind of use as like a short-term bear bull measurement, they certainly could. But I think people should beware. These things could certainly go down 90% very easily without any surprise. All right, so can we move on a little bit to some stablecoin optimizations? Because one of the things I've done is put my staked ETH in Aave, and I've borrowed stables against it, which is really cool because the amount of US dollar terms, your debt stays the same, but your staked ETH is rebasing every day, so your collateral is going up, so it just becomes a smaller and smaller portion of your total loan to value. But what could you do with those stablecoin tokens? And I think in the Discord, Eric, you had dropped like some of your top 3 stablecoin farms and yield opportunities you've been going in. You want to cover some of those, and maybe at some point we can get into the risks of each of those.
Yeah, I think like it's especially poignant when we're talking about we might be headed towards a little more goblin town anyways, like things might get a little uglier in the near term. So like, maybe at 3,200 ETH, you don't want to be like necessarily staking ETH right now. Maybe you want to like wait until ETH's a little lower, which would mean you go into stables first, and then you can like get more ETH to stake a little later, for instance. So I've been looking at it, and like, keep in mind, guys, I'm coming from traditional finance, right? So like we have inbound demand from clients who are like non-crypto native guys. These are like meat space, like lawyers, real estate guys who have money, and these guys are asking me this simple question. They're like, God, Eric, if there's only some way where I could like yield, like they're bearish on the markets broadly. So like if I could just like take cash and yield on it and have it be liquid, that would be just like a dream come true. But I hate crypto. And I'm like, okay, well, I have a perfect solution for you, but it's in crypto. So like these stablecoin yields that we're talking about are amazing. Like, we're capturing, near 20% or, probably in some cases upwards of 20% yields on dollars, like digital dollars that we call stablecoins. And I think what this next conversation is going to be is like, what are the risks of these stablecoins? Okay, so the way that I look at it is in traditional finance terms, you have 2 types of risk. You have systematic risk and idiosyncratic. Systematic is like what's the risk of like stablecoins at large, and then idiosyncratic is like what's the risk of an individual stablecoin or an individual protocol. So I think that's like a good way to like frame it from the get-go. So systematic risk in stablecoins is like, what if regulation, like, US government starts to regulate stablecoins, they like ban them, they want only like the central bank digital currency or something. That's a risk. I think that's a real one. And I don't know how that really plays out. The systematic risk is difficult to pinpoint today. The idiosyncratic, I think, has multiple layers. So when you're talking about each stablecoin itself, you have like USDC and USDT. These are like backed stablecoins, and then that's separated from the algorithmic stablecoins, right? We're all familiar with this, but like not a lot of people are. So like a backed stablecoin has like US dollars in a vault that represent each USDC stablecoin on the blockchain. But then there's algorithmic ones that are pegged using math. Right. Okay, so those are their own idiosyncratic or like independent risks.
And we did cover an example, by the way, UST last podcast. So we did touch a little bit on algorithmic stablecoins.
Okay, nice. Okay, so and then when you actually go to try to use these things to actually generate yield, then you add on a new layer of idiosyncratic risk, and that's when you like you trust a protocol or like a mathematical vending machine to like actually pay you and keep your money safe. So that's a whole nother layer. I think like when we're looking at this, we can all even disagree on what's the safest or what's the riskiest. I think there's like crypto heads at the core value system don't believe in fiat currency, and they think that like USDC is very risky because it's based on fiat. It's like it's backed by dollars in a vault, and that's based on fiat. Whereas like my people are going to say like, well, that's the safest. Like that's the system that I'm used to. So I think that's a good frame, and I'll let you guys take it from here.
Well, I was going to say, maybe if you could, given that frame, now can you give us an example of one of the applications that you're using to yield either Anchor or Stargate or Balancer, and then while you describe it, maybe kind of associate those risks to like that example, so we can.
I think before we do there, I want to like just make sure we do like one more little delineation, right? We talked about algorithmic versus like collateralized, right? I think it's important to distinguish like between the types of collateral, right? Like you have USDC, which is 1-to-1 actual dollars in a bank, governed by, US law, right? But then you have USDT, which is cash equivalent assets, which may be bonds or even corporate debt or something sketchier, allegedly offshore in a bank, right? But then you also have like a very big category, which is important to talk about, which is over-collateralized, right? And typically the over-collateralized are over-collateralized because they're collateralized with crypto, right? So this is the main thing we want to talk about here is DAI, which is basically like every DAI is backed by like ETH in like a maker vault, right? And there's way more ETH than the value of the DAI, right? It's over-collateralized. And then
it's like a 2-to-1, kind of like, right? 1.5 ETH for every DAI dollar.
Yeah, I mean, it fluctuates depending on how aggressive people are being with their vaults, but that's probably about right in aggregate, right? And then you can kind of go down the risk curve, right? Like we have MIM, Magic Internet Money, which is sort of like, it's basically like MakerDAO, but with riskier collateral. And I use it a lot because it's very degen friendly. Like instead of using ETH as collateral, you can actually use the Y-Curve ST-ETH pool as collateral, which I forgot to mention in my strategies, but that's like a fun degen strategy, right? Because you take your Lido ETH, you put it in a convex pool, you earn like 8% in the pool, and then you can borrow Magic Internet Money against it at only 0.5% interest, right? Which gives you all of these stables to then go do other degen stuff with, right? So that's kind of like a fun out the risk curve thing. We can talk about that more in the Discord. We don't have to go into it too much.
No, here. That's a good point. That's a very good point, because like each one of these things is going to be backed by something different, collateralized by something different, and that will bring out its own inherent risks within each stablecoin itself. And then when you go on to the protocols to like yield off them, you'll notice typically that like the yields are different based on the risks of each stablecoin itself, right? So like within Stargate Finance, for instance, this is one that we talked about in our Discord. You'll see that I can even pull it up now, but like you'll see that USDC will probably give you a lower return than you'd get on USDT, because USDT is a little riskier inherently.
So when we look at risks, the base risk, the primary risk is what is the stable coin that you're in. Yeah, what is the coin? Okay.
Right. So I think maybe we all agree on this, but maybe we don't. Like I think DAI and DAI based stablecoins are probably the safest of all,
because they exclude regulation risk, where USDC could fall in the regulation territory. Is that right? Why?
They're not using fiat currency as the collateral, and the fiat could be.
I want to see Steven's take on this specifically.
But they kind of are, and this is where like there's a lot of this gray area, right? Like, one of the problems with over-collateralized stablecoins is they can't really scale to meet demand, because you can only generate as much of them as you have collateral, right? Now, this has caused Maker to start using other things as collateral. But one of the things they're using as collateral is USDC, right? And now we can talk that like maybe this will get phased out in the future. But you have this weird in-between thing now where like a portion of the collateral is actually this kind of like semi-regulated fiat based thing, right? So it might not be as pristine as we want it to be. But I think that what you're saying, Eric, in like a vacuum or in like my ideal world, or how it used to be, because it didn't used to be like that. Like I would kind of agree with you. Like DAI would be my kind of go-to, like go into a coma and like nothing in the world can touch my stable coins thing. But I'm actually not sure of that anymore. And I've been diversifying myself.
That's a fair point. I like where your head's at. I think I'll just take the opposite side of it. And I just think like when I first heard Justin Drake talking about the need that you're describing, which is like, we need more collateral for DAI to make DeFi more sustainable. It made me uber bullish on Ethereum, like made me uber bullish on Ether token price, where it's like, oh my God, these guys are gonna fucking pump ETH to make DeFi make sense. Like, because the price of ETH is inherently connected to your stable coins. So like,
we didn't even talk about Frax too, which is kind of like its own like in between category, right? Because Frax
describe the basics for us, yeah.
Yeah, Frax like a 10,000 foot view, right? It's a hybrid between a collateralized and an algorithmic stablecoin, right? It basically has the ability to dynamically float between anything from 0% to 100% collateralized, right? And the aha moment with Frax was that like the market itself is going to decide what the collateralization ratio should be, right? It's capital inefficient to like have a coin 150% collateralized if the market would be fine with it being 70% collateralized, right? And there's been like a big revolution in the last like week, right? There's been a lot of stuff stirred up with the advent of this thing in Curve called the 4 pool, right? For a while we've had the 3 pool, which was USDC, DAI, and Tether, right?
Tether, probably.
Yeah.
USDT.
And that was like the T-bills of DeFi, right? But now like we've got this thing where Terra with their UST coin and Frax have sort of come together, and they made the 4 pool, which is this pool that is causing a lot of controversy because a lot of people are like, whoa, we're going to make this like baseline pool of like DeFi stable liquidity based on like completely algorithmic or partially algorithmic coins. Like, what are the risk effects of this? But the upside of this is that users who are willing to like hold these coins and use this pool can get like insane yields on their cash right now, so this is another thing that I'm working through at the moment.
So you guys know this, but it's important to point out that like when you provide liquidity using 3 or 4 different stable coins, and one goes to shit, like you're not like 75% okay, 24% gone. Like you end up getting 100% of the shitty one. That's how liquidity providing works. So like if one breaks and you're providing liquidity to all 4 of them, like you end up with 100% of the one that broke. And I don't think that like that's not inherent to like traditional finance. People don't understand that. They think, oh, diversification. We're going to be safer this way. It's actually the opposite.
Right.
That's such a good point, because I think some people who might not know what they're doing, they might see a pool with like 4 coins in it, and USDC is one of the coins, right? And they're like, oh, I'll put my USDC in this pool and I'll make 14%. And oh God, well, maybe one of the coins dies and the pool loses 20% of its coins and I'm down 20%, but that's okay because I've been earning 25% interest and I'll live with that. And that's not how pools work, as Eric said. Like if one asset goes to 0, the whole pool goes to 0. So that's if you're gonna do the LP thing, that might be a thing you want to educate yourself on if you're a listener who's interested in that.
So let me ask you guys, like, what's your hierarchy of stablecoin safety?
USDC, DAI. After that, it gets a little dicey because then we're talking about Tether or UST. Tether's backed by some shitty commercial debt, company loans.
That we don't even, we have no clarity on.
Zero transparency.
We have no transparency.
Backed by like another token, Luna, and we've talked about it last episode. You can check it out, which and also will be partially backed by Bitcoin. and we get into murky territory.
I'm so bummed I missed that fucking conversation on
you. I mean, we needed
USD.
you on it, to be honest. It really let us down. But I would say USDC and DAI, and like if any listener wants to go deeper into the USDC, you should understand Circle. There's a company that manages USDC, and if you want to understand it more, you have to look into the company Circle and what they do, and they have other services and ways they make money. But the CEO of Circle has to go up in front of Congress and testify, and so understanding that dynamic is important.
I think what might be good is to just like quickly bullet point the risks of the different categories of coins. It's super quick. Like USDC, it's not going to go to zero, but like Circle actually has the ability to like freeze wallets, and you're basically taking on US regulatory risk by holding that coin. Like the government could basically decide that you can't move your cash anymore, which is unacceptable for some people in DeFi. But if you're like a casual TradFi guy who's just trying to earn yield in the DeFi world, that might be totally fine for you. You're more concerned with your coin going to zero, right? Tether, risk there is pretty like obvious, right? There's the risk that there's just some shenanigans going on in the Bahamas and there's no money there, and one day you wake up and there's like a run on the bank.
Tether's backed by like 70 cents for every dollar, as far as I'm concerned. Yeah, right. Something like that.
Yeah. Like, and I personally don't see a ton of risk there because I kind of believe that the market prices these things in, and the market seems to not price that in at all. We have over the course of years and just trillions of dollars in trading, right? So
a lot of Lindy,
important. UST, algorithmic stablecoin, right? The risk on a coin like this is the death spiral, right? The way these things are designed is that you can have this effect where people start kind of like selling the algorithmic collateral that backs it, which causes this loop where everything just kind of spirals down to nothing, or it spirals down to the amount of collateral. Like Luna may have 8% of the collateral in Bitcoin, right? Or UST. So if everything totally nukes, like it might just go down to its redemption value, which is the 8 cents on the dollar of Bitcoin.
Does anyone remember Iron Finance? Because I sure do.
Oh, we touched on it, brother.
We touched on it last week. You should listen to the episode. It's a good episode.
Yeah. I needed the episode. Okay, keep going.
Yeah. DAI, you have smart contract risk, right? There's always a chance that there's some bug that people haven't discovered, and if it were to be discovered and exploited, it would probably blow up like just everything in
existence. Goodbye crypto.
Just goodbye everything, right? So that's your risk there. Again, we have Lindy, a lot of time and a lot of money. It's just like an enormous honeypot for a long time, and nobody's cracked it. But that might not be comforting to some people. So I think that's a good baseline on the risks of algo, over-collateralized, regulatory, but backed in a bank, and backed in a bank, but not regulated, right? Those are kind of good high-level stuff. And then
Steven, great summary.
Somewhere in between there.
Incredible summary. Oh my God, I'm blown away. Amazing.
So I want to make sure we cover some of the questions that the people, some followers in the Discord have mentioned. Well, I mean, I think they wanted to go through. So Eric mentioned some stablecoin yields. He specifically mentioned Anchor, Stargate, and Balancer. And one of the biggest questions was, tell me the risks I'm taking, because Anchor's got a 90% yield, Stargate's got a 90% yield, Balancer's got a 12% yield. If I was just being simple, I'd pick the highest yield, but obviously there's some risks involved, and we just covered the baseline risk, which stablecoin you're using to yield. So can we maybe talk through some of these, yields and their risk that we're taking?
Can we save Stargate for last, please? Okay. All right. Okay. So Balancer, let's start there. Balancer was, at the time that I put that in the Discord, Balancer was yielding something like 12.5% on the 4 stablecoin pool, which was this was on Polygon, by the way. So these were like the L2 stables. So this was like USDC, Tether, DAI, and Mematic, which is now rebranded to MAI. Okay, so when you go into that pool, you're exposed to the risks of the 4 stablecoins themselves. Mematic we didn't mention yet, but it's like a copy of DAI, but just on layer 2. And then you're exposed to Balancer, the protocol risk. Balancer itself is like near blue chip for me. Like you guys tell me if Balancer is near blue chip for you, but for me, it's like it's almost there. So I think like with that one in particular, you're really mainly concerned about, what's the risk with Tether? What's the risk with DAI and MAI? I think, what's the other one? Anchor. You guys probably covered Anchor in the last.
Can I follow up question on your Balancer mention? So with Balancer, are you earning in the BAL token? Correct. That 9% yield comes in the BAL token, and if
fees.
so, and trading fees.
But it's probably mostly some of those pools are tricky too, because I think like that my pool is also subsidized by ChiDAO, who makes
you get paid in a little bit.
Sometimes get multiple reward tokens.
And BAL.
But that's not usually a source of risk, right? Because those rewards are gravy. You're not going to lose your money by getting a token deposited.
But your yield, is dependent. Your yield is dependent on the price.
You have yield risk. Yes.
So tell me how to handle this. If I'm a small stack, and I'm getting yielded in BAL and Chi, am I selling this every month and just turn into stables just to make sure I can kind of try to lock in my yields as much as possible, or am I letting them ride? What do I do if I'm a smaller stack?
The way that I handle everything in DeFi is to dump reward tokens all the time. But I did ask Steven about Stargate, and Steven in particular is bullish on Stargate rewards token. So like, I think it's like, do your own research, your mileage may vary. But for me, like I'm in there to generate yield. Like I'm like a TradFi guy. So like for me, this is just like a yield farm. I'm going to take my yield and convert my rewards tokens straight back to harder money, whether that is Bitcoin, ETH, or stablecoin that I can compound. But like, that's where I land.
Yeah, I think the simple heuristic is like, if you wouldn't go out on the open market and just buy that token because you really like it and you think it's going to go up, then you should just sell it for stables or sell it for ETH. Good default strategy for people is just sell everything and compound into ETH. Like if you're trying to like grow your portfolio over time by the highest amount, like that's probably going to be like the highest performing strategy by far. I sell a lot of stuff for stables because I use cash flow to pay for rent and stuff like that, and that's because I just kind of farm for a living almost. So, but I think most people who are just farming to like make more money should be just compounding into ETH. And
Steven's there with his overalls.
Yeah, his overalls, just farming for rent money.
It ain't much. It ain't much, but it's honest work.
It is honest work.
Yeah, I think what might be helpful for people is to kind of just walk them through like a particular, and maybe this will be a little complicated, but this stuff like kind of is complicated, right? So let's like walk through like a really extreme scenario, right? Where but like a common one, like say you want to farm the 4 pool, which is your Frax and your UST and USDC, and I forgot what the other coin in there is, but it's basically like Frax and UST are kind of the things giving it like the super yield, right? Now you may farm that like using an aggregator, right? So you may go through something like a Yearn or a Beefy, right? And that's like actually working through Convex, which is working through Curve, right? So it gets kind of nutty, right? So you start.
You lost everybody.
Yeah, I know. So I'm going to back up for everybody, right? You start with the coins, right? So the coins themselves have risk. Like if you hold the UST token, you have risk. If you hold Frax, you have risk, right? You then take these coins and you put them in a Curve pool, right? That's sort of the start of the process. Well, you now have exposure to Curve, right? Now, a lot of people use convex finance to boost the Curve yields because like Curve has this complicated boosting feature to get the max yield, and normal people can't do that. So they actually go into convex and they will put the Curve token in convex. Now you've got stablecoin risk, you've got the risk of Curve, and you've got the risk of convex. But now some people might go even further and they might use like an aggregator stacked on top of that, right? And you might use something in the realm of Yearn or Beefy or one of these yield aggregators, right? So now you've got your stablecoin risk, you've got your Curve LP risk, you've got your convex finance risk on top of that, and now you've got your aggregator risk, right? So you've basically got 4 layers of risk here stacked on what might be like a 20% yield right now, which is a pretty juicy yield. But it's important to know that like you are basically stacking risk on top of risk on top of risk. And if any one of those links in the chains breaks, like goodbye money.
Perfect. That's what I wanted to say. At any weakness in any of those, you go to zero. That's the key.
Tell me the upside of this. Like, obviously, these returns are much healthier than I can get at a normal TradFi market. Some of them sound higher than even just staking my ETH in Lido. They're more than 4 or 5%. But is there opportunity? Is there upside in the Curve token, in the Convex token, that could potentially juice these yields if the greater world kind of catches on to this and participates?
I think let's focus on the risk side before we start talking about like the juice and the yields more. Like, I think
cool.
What Steven probably looks at all the time, what I look at when I like enter any of these is like, I want to see that this thing has existed for long enough such that the money that exists in the protocol pays the devs enough so they're not incentivized to steal from you. So like smart contract risk can always exist. Like the devs can like program it wrong and you can lose some money. This happened on, like indexed finance. The devs were all like upstanding individuals. They just programmed it wrong and we lost money. But like, if you get big enough and lindy enough, which means like if you're around long enough, then like the devs are incentivized to keep the protocol going because they'll make more money off of the operation of the business than they will from stealing. And for me, that matters in a big way.
Yeah. I mean, it might surprise people, but like, I don't do like a lot to like investigate the safety of a lot of these things. There's like a sort of high level checklist I have. Like I've looked through so many things, right, that I think I can kind of filter out 80 to 90% of the obvious scams like as soon as I see them. And then there's this sort of general acceptance that there's going to be risk throughout DeFi with everything I do, right? So my goal is not to capture like the highest yield in one thing. My goal is to kind of like, I view yield as like multiple bets that I'm making, right? And depending on like your bankroll, right, and how much gas affects you, you can do this to less and less degrees, right? But if you've got a big bankroll and you've got money on like all of like the layer 2s or the alt layer 1s where gas is cheap, what you can do is just put like a tiny chunk of your stack in a bunch of different protocols, right? This can be deceptive though, because sometimes multiple protocols actually all feed to the same thing. And that's something you have to be aware of, right? Because it gives you like the false illusion of diversity, right? But if you just generally speaking, spread out your risk into a bunch of different pools, you eliminate the obvious stupid stuff, right? Or things that are like obvious scam, like deposit fees and stuff like that, right? Stuff that like kind of OG people are like, I'm not put, why is that yield 900%? Oh, there's a 4% deposit fee. Like you filter that type of stuff out. It just becomes a matter of spreading out between different stable coins, different protocols, especially different protocols that like the base layer, not the one that's on top, but the ones that are stacked, right? And if you do that, and you have your money in like 10 different pools that are all diversified, you're going to be okay, right? The odds of like something that has like 600 million or $1 billion of TVL, that's the other thing too. Like you want to look at the money that's in there. Like, cause there's a certain thing that says like, okay, if $10 billion is in this protocol, it means that there are some guys with a lot more to lose than I have, right? And they're probably not just parking their money here without doing any due diligence at all, right? So that's kind of like how I tackle it at a high level. Filter out the obvious scams, spread out the bets between protocols, spread out the bets between coins. And then the other main thing I do is like I really take my time into account. I don't just jump into anything when there's like a 60% yield because I'm aware that may just compress down to nothing within like a day or two, and then like you end up losing all this time or money moving stuff around, right? So you have to optimize for your time too. There's this guy on Twitter who's a very famous trader, is a gigantic rebirth, and he's put out this thing called the efficient yield hypothesis, and he basically said there is no free lunch in yield, much like there's no free lunch in the markets. Like if there is a high yield as a generalized rule, it's probably because there's some risk in there that you don't see that the market is pricing in. I think that is generally correct, but I also think there's an additional thing being priced in, which is the premium of people's time to kind of like manage these strategies, right? So if you're somebody who's willing to trade a little bit of your time to kind of do this, I do think you can actually get like a good chunk of yield beyond the market rate. And if you're willing to also stack diversification on top of that, then you can kind of push that up as well. So that's kind of what I would say on that.
So I think another thing I'd say is that I just onboarded a normie into the crypto space who comes from the TradFi world, and he's blown away by the yields that exist, the opportunities, the composability, like blown away. But also, it's very clear to me how quickly fees can deteriorate all of these returns if you don't get quickly onto a layer 2 and you're not just like a freaking whale. So, like all of these things that we've talked about exist on chains that are not ETH mainnet. And, if you're going to look to yield stablecoins, don't be on ETH mainnet.
Yeah, I'd be curious to know what's your favorite, non-ETH place to do DeFi and get yields, maybe like an EVM compatible one. And then if you're pure ETH Maxi, you want to know what's your best layer 2 to play DeFi games in. What are some of your favorites?
Yeah, I mean, if you're somebody who likes to chase stuff and doesn't mind managing a bunch of positions like I do, I mean, I think some of the best yields in DeFi for a long time have been on the Phantom chain. There's been a lot of projects that have launched there that have been like recently DS Finance, right, has had pretty sustained 50% plus yields on stables. It's like a little slightly more complicated to kind of extract that yield. There's a bunch of kind of things you have to mix together. But there's been a lot of 20-30% kind of farms on there for the last year. And if you've just been rotating capital from place to place, you don't mind doing that, and you're minding your slippage. That's a good point that I think Eric makes up, that people need to be mindful of if you want to do this in a really active manner, right? Even though USDC and DAI are both $1, if you're swapping back and forth between them all the time, especially if you're swapping back and forth between some of the higher yield but like lower liquidity stuff like a Frax or a MIM, right? It's very easy to get wrecked in gas and slippage. Like you lose money in the trade going back and forth, and you lose money in the gas, and pretty soon like that makes up that's eaten away by like the yield you would have made, right? And like a lot of people, the hard truth is they would be better off just focusing on like what is like the middle ground between like risk and like time and lending. And like for me, for most people, that's going to be just like using Curve. There are good yields in Curve. Curve exists on basically every chain. It's got enormous amounts of Lindy, right? And so if you want to just kind of set a bunch of stuff and forget it, you can basically diversify across like a bunch of stable coins in Curve and then kind of call it a day, right? You can kind of check Polygon, Avalanche, Phantom, whatever to kind of see like where the yields might be kind of best on average. But that's going to be like, I think, the best balance for people. If you want to get the best yields that are around right now, they're going to be in UST. That's why the Luna price has been going completely haywire. But there are kind of some risks there, as we've talked about.
What about ETH layer 2s? Like where is the best DeFi ecosystem for yields and layer 2s? And you maybe not have found it. Maybe nothing's impressed you to date, but has anything kind of caught your eye where you're like, okay, it's enough to start bridging over a good portion of funds?
The only layer 2 farm I guess it's a question is if you like consider Metis a layer 2. Like to me, that was like a very hit and run kind of eco farm thing, which I got really like there were really good yields on there for a couple months, but like I don't really expect that to be like a sustainable thing. Arbitrum really never had yields until recently. Like they've started to become reasonable in certain places. The most recent one has been Stargate, right? But Stargate's on basically every single chain that exists. But like I've been in some Stargate pools on Arbitrum for a few weeks now. That's been a great place to earn stablecoin yield there. But I would say as a general rule, that has not been the place to be. There's like more happening on your Avalanches and your Phantoms and your basically this sort of like I guess Phantom's not really a VC backed coin, but like these coins where they're juicing the ecosystem with like the native token rewards. It's like really hard for like Arbitrum to compete with those yields when they're not dumping Arbitrum tokens as like incentives into these pools to juice them up. And that's been a good strategy, is to stay in ETH, but to move your ETH and stables from all of these other chains and just kind of soak up all their rewards and kind of bring them back home to ETH someday.
Anything on optimism, by the way? Like
Optimism to me has been so much worse than Arbitrum for a while. It's starting to pick up. I've actually been meaning to kind of look into it a little bit more. But like last I checked, there's still a lot more to do on Arbitrum, although I don't think that's going to continue to be the case for like a very long time.
So I think anything else we should cover on stablecoin yields, the risks and certain protocols before we start to
I got
wrap
a
up?
couple other just simple things. I know we talked about a lot of stuff that sounds pretty complicated. I think there's probably a lot of people who just want to be like, oh, hey, I have cash. How do I just start playing with stablecoins? I'm gonna once again throw Argent wallet out there because I think it's really good for people to kind of bridge them onto stuff.
Sorry to interrupt, but I know a few people on our Discord. They're in other countries other than the U.S. They're international, and they've mentioned that it's tough for them to get fiat money onto Argent. So is there anything like similar, or what would be the next step outside of that, even if it is a little more complex?
Yeah, I mean, beyond that, like if there's not that equivalence in their country, right, you're just going to have to use an exchange probably. You put your money in like a Coinbase or a Binance or FTX equivalent. And the first step is to swap the cash in your bank account for a stable coin, right? And then most of these exchanges will right there have like some sort of earning feature for you where you can like leave your stables in Binance or FTX and like earn a yield on them. And that yield is almost always going to be better by orders of magnitude still than the 0.03% that your banks are paying you. It's just like a joke. So that's already like a small win for most people, but it's not really going to move the needle, right? But it's a good baseline. I think beyond that, if you are a sort of like medium user who wants to play around a little bit and you don't have the ability to use these kind of simplified wallet apps, like I think the thing you really have to do if you're not a whale is to figure out the best way to get your funds from an exchange to like a layer 2 or like an alt layer 1, because otherwise gas will kill you. So certain exchanges have direct withdrawals to Matic, like I know like FTX, for example, for foreign people, has a direct withdrawal to Avalanche, and that's like a really good place to start. Or obviously they have direct withdrawal to Solana as well. So Solana and AVAX ecosystems both have a ton to do as far as like stablecoin yields, right? And then when you're on those ecosystems, like the very basic stuff is always going to be to just deposit your money in a lending platform. So on Solana, you have Solend. I hate the names of this stuff on Solana. Just put Sol in front of everything. But you're going to be able to put like just USDC or UST in Solend and just earn interest, right? And it'll be like anywhere from like 1 to like, sometimes it spikes up to like 20% depending on the demand for them. But you're usually going to see it in like the, 2 to 3% range, I think, when the market's kind of tame, and you can pump up into the double digits during bulls, right? On AVAX, you have a couple of options. You've got Aave, which is kind of like the most blue chip one. You've got Benchy, which is like the AVAX native one. And then Trader Joe, like the big exchange on there, has their own lending marketplace as well. I don't really use it that much. I'm almost entirely on like Aave and Benchy when I'm on AVAX. If that is like kind of you get the hang of that and you want to go further, I think the next step for people is to do like a Curve. I don't think Curve is on Solana, right? So they have like their equivalent kind of like I forget the name of it, but they have their kind of equivalent like stablecoin swaps there. But on Avalanche, for example, like it's very easy to use a couple things on there. Avalanche is actually like a really great place to get into this for people. It's like it's very cheap to use. It's getting actually more expensive, but like still like very cheap compared to ETH, and you can kind of get money on and off there very easily. So good options on Avalanche. One, if you're comfortable with the risk, is to use Anchor. Anchor, you can very easily just swap. You can get UST on FTX, for example, withdraw to Avalanche, and then you can put UST into Anchor protocol and just earn 19.5%.
Sorry, just so I'm clear, on FTX, you can withdraw. Is this FTX US or
no?
I'm
talking about for international people, because we were like, oh, these people can't.
Okay, so FTX.com, you can withdraw direct to AVAX chain, Avalanche.
I'm actually
chain.
not sure if they have UST withdrawals yet. I know they're going to enable them. You can buy UST on
Trader
FTX
Joe.
though, and you can definitely withdraw USDC and AVAX to Avalanche, right? So worst case is you get a USDC to AVAX, you swap USDC for UST using one of the curve pools, and then you can kind of get your high yield on your UST. But
again, only for
only
for FTX.com, not FTX.US.
Correct. Like a US user is not going to be able to get money. US users, generally speaking, have to withdraw to ETH mainnet and then use one of the bridges.
And then bridge. We're getting jobbed. Come on, Gensler.
Yeah, it's real.
Loosen up, guy. All right. Anything else we should touch on, Stephen? Anything else on your list there that we should cover?
No, I think we hit everything. I mean, you know me, I could ramble forever, but I feel like we
that was a good
that was a pretty dense episode.
The Discord special, the DeFi special.
Do we get all the Discord burning questions?
We did. I mean, people want to know just risks in some of these, specifically the stablecoin yields, and I think we touched on them. But if we didn't, throw follow-up questions in the Discord. We touched on a lot of stuff. We touched about ETH staking options, stablecoin staking options, some very basic yielding strategies, and some more advanced ones. If anything has tickled your fancy and you want some how-tos or follow-up questions you have, throw them in the Discord. We're in there every day answering questions and also just throwing some general thoughts about the markets in there and things we're trading on. So fun place to be. Eric, anything else that you think we should touch on beyond that?
Not really. I would just say that the things that I throw in the Discord are inherently things that I've looked at or done myself. I'm not going to just throw something unvetted in the Discord. So I talked about Balancer, I talked about Stargate, and I talked about Anchor. So these are three things that I am deeming as investable, but also do your own research. But this is what I'm looking at. So if you guys want to go there, that's fine.
And I think as a group and a cohort, we're trying to understand really give me my best yield for the least amount of risk. That's what we're really talking about. So if you can do us one up, if you got a better option, better strategy, throw it in there, because we're obviously all ears and we can all help each other out if we throw some ideas in there together. We've talked about some of our favorites, but anyway, hope you guys enjoyed. Guys, I think that's a good place to wrap. We miss Crypto Kebab, Arman Asadi. He's going to come back with some Bitcoin conference alpha. Not bullish on there's going to be a whole lot of alpha to dish from a Bitcoin conference, but we'll try.
Happening coming in 2 years.
Oh wow, didn't see that one coming, but yeah, we'll definitely.
By the way, how funny is it on a closing note that once again we dumped at the Bitcoin conference?
Oh yeah.
Oh no.
Tale as old as time.
I can't believe I went long into the Bitcoin conference. I need to.
But you put a tight shortstop on there.
I did. I managed the risk well, and I sold a bunch of shit coins, but I still did long. I did long BTC. I gotta wear that L on my shoulder.
And since I'm the dictator for this little podcast, I'm gonna put a shortstop on our podcast. I think this is a good recording. All right, guys. I think that was fun. Great job.
Good job, Nick. Way to moderate.
Bye,
buddy.
Bye.
All right, thanks.